Fourth quarter, 2025. More than 1 in 5 people who buy a new car in America sign up for a monthly payment north of $1,000, not the price of the car. The payment, just to drive it off the lot. The average new vehicle now costs just north of $50,000. The average amount financed hits an all-time high of $43,759. And to make that number survive contact with a real human paycheck, 1 in 5 of those loans now stretches 84 months or longer. That's 7 years. You could finance a car in 2025 and still be paying it off when your kid starts driving. Zoom out and the math gets stranger. Total auto loan debt in the United States has pushed past $1.6 trillion. That's not a typo, and it's not a small comparison. That number now exceeds total student loan debt in this country. Somewhere along the way, buying a car quietly became a bigger national financial burden than a college degree. So here's the part that doesn't add up. Auto loan delinquencies are sitting near 15-year highs. People are missing payments at a rate we haven't seen since right before the last financial crisis. Automakers, meanwhile, have largely walked away from anything under $30,000. The cheap, reliable car is basically an extinct species. Every signal in this market points to buyers who are stretched, squeezed, and quietly drowning. And yet, the average dealership in America pulls in about $4.1 million in pre-tax profit a year. That's not revenue. That's profit. And it's double what dealerships were making back in 2019 before any of this got bad. The blue sky value of a dealership, basically what buyers are willing to pay just for the business itself, averaged $20.9 million in 2024. That's 122% higher than pre-pandemic levels. So hold both of those facts in your hands at once. Buyers underwater, missing payments, financing cars for the length of a mortgage. The people selling them those cars getting richer than they've ever been in the history of the business. That's not a coincidence, and it's not a mystery you can wave away with. Inflation. Somewhere in that gap between a buyer's ruin and a dealer's record year, there's a system, and it was built quietly and deliberately to work exactly like this. Let's start where everyone assumes the money is, the car itself. Because if you wanted to point a finger, you'd point it at Ford or Toyota or GM. The manufacturer. The name on the hood, they're the ones setting the sticker price, right? So they must be the ones cashing in. Except, look at the actual math on new vehicle gross profit, the amount a dealership makes per car, before overhead, before anything else. In 2024 and into 2025, that number sits around $1,840 to $2,326 per vehicle. And that's not a typo, that's a collapse. Because back in 2021, during the pandemic chip shortage, when inventory was scarce and buyers were fighting over whatever sat on the lot, dealers were clearing $5,000, $6,000, sometimes $7,000 a car. That was the peak. This is nowhere near it. So here's the strange part. Per-car profit is down more than half from its high. Manufacturers have quietly abandoned the entire sub-$30,000 segment, the cheap, high-volume cars that used to be the industry's bread and butter, because the margins on building them just aren't worth it anymore. By every measure that should matter, the car itself is a worse business than it's been in years. And yet, the average dealership still pulled in roughly $4.1 million in pre-tax profit in 2024, still double what it was in 2019. Still, by any historical standard, one of the best years the retail side of this industry has ever recorded. So if the car itself is making less money, where is $4.1 million a store actually coming from? Here's the reveal, and it's the kind of thing that only makes sense once you stop thinking of a dealership as a place that sells cars. Because it isn't, really. Not anymore. The car is the bait. It's the thing that gets you through the door, gets your signature on a piece of paper, gets you sitting across from a finance manager for 45 minutes you didn't plan on. The actual dealership, the business, the real estate, the brand relationship, the thing appraisers value at an average of $20.9 million in blue sky goodwill, that's not a car lot. That's a financial services company wearing a car lot as a costume. The car is priced to move. The money is made after you say yes. And once you see that, the two facts we opened with stop looking like a contradiction. Buyers going underwater and dealers getting richer aren't opposite trends. They're the same trend, viewed from two different rooms. So now the real question isn't why dealers are profiting while buyers struggle. It's asterisk how. What's actually happening in that back office? In that 45 minutes, that turns a shrinking product margin into a record-breaking business. That's next. And if you want to actually see how that machine works, subscribe, because it gets a lot more interesting than undercoding. Here's the part almost nobody outside the industry actually understands. A car dealership isn't one business. It's four, wearing a trench coat. There's the new car business, which is basically a loss leader now. Average gross profit per new vehicle has collapsed to somewhere around $1,840 to $2,326. That's before overhead. That's not a typo, and it's not a mistake. It's bait. Because the moment you say yes to the car, you walk into a second business, financing. The average buyer isn't paying cash. They're financing $43,759, an all-time high, and increasingly, they're doing it over 84 months, sometimes longer. Over 20% of new loans now stretch that far. The dealership doesn't just sell you the car, it sells you the debt, takes a cut arranging it, and then sells that paper upstream to a lender who prices in the risk you're carrying. Then there's business number 3, F&I, finance and insurance. The extended warranties, the paint protection, the gap coverage, the 45 minutes in the back office we mentioned earlier. This is where the real margin lives now. Higher margin than the car. Higher margin than almost anything else on the lot. It's also, not coincidentally, the part of the transaction buyers remember the least and regret the most. And business 4, service. Once the loan is signed and the buyer drives off, they're still coming back for years, for maintenance, for repairs, for recalls. Even as delinquencies sit near 15-year highs, the service bay doesn't care whether you're underwater on the loan. It just cares that the car still needs an oil change. 4 businesses, 1 building. And here's the strange part. Automakers have largely walked away from anything under $30,000, which means the cheap escape route is gone. Buyers are pushed upward into bigger loans, longer terms, and more F&I product, whether they meant to be or not. Now layer on the part that actually protects all of this, the franchise system itself. You cannot just open a Toyota dealership because you feel like it. State franchise laws carve up territory, restrict new entrants, and hand existing dealers something close to a legal monopoly on their patch of highway. That scarcity has a price tag. It's called blue sky, the goodwill value of simply owning the license. And in 2024, it averaged $20.9 million per store. Not the real estate, not the inventory, just the right to exist there. Put it together. Thin car margins, fat financing margins, fatter F&I margins. Put it together. Thin car margins, fat financing margins, fatter F&I margins, and a legal moat that keeps competitors off your lawn, and you don't have a car business anymore. You have a toll booth. The vehicle rolling off the lot is just the ticket that lets you into the building, and that's why the math stops making sense to the buyer and keeps making perfect sense to the owner. The customer is drowning. Average loan north of $43,000, payments crossing $1,000 a month for 1 in 5 buyers. Delinquencies at a 15-year high. From the buyer's side, this looks like a system on the verge of collapse. From the dealer's side, it looks like Tuesday, because the dealership was never actually betting on that customer walking through the door happy. It was betting on the customer walking through the door at all. Once they're in the building, the franchise structure does the rest, financing them, insuring them, servicing them, upselling them for years, whether the sticker price ever made sense or not. Automakers have quietly walked away from cheap cars altogether. There is barely a new vehicle left in America under $30,000. That's not an accident. It's an admission. The industry looked at the affordability crisis and decided the winning move wasn't to fix it. It was to build a business that doesn't need affordability to survive. That's the twist hiding underneath the whole story. Every other retail industry lives or dies by whether the customer can still afford to buy. Car dealerships built a legal, financial, and structural cushion specifically so they wouldn't have to. Blue sky value up 122% since before the pandemic. Store profits still double what they were in 2019, not despite the affordability crisis, running straight through the middle of it. So no, the dealership down the street isn't secretly some genius operation outsmarting the market. It's something quieter and a little more unsettling, a business the states themselves protected decades ago, before anyone knew what a subprime auto bubble would look like. Nobody had to rig the system in 2025. It was already built this way in 1955. They just kept the lights on and let the math run itself. The buyer changes every few years. Wages rise, wages stall, rates climb, rates fall. The dealership just sits there, collecting the toll, outlasting every single customer who ever thought they were the one buying the car, when really, they were just the fuel. If this kind of, wait, that's strange, here's why it actually works, story is your thing, subscribe. There's a lot more of the machinery behind ordinary things waiting to be pulled apart. And if you've got a system you want unpacked next, drop it in the comments.